Good evening, guys. Thanks for tuning in. Thanks for watching my videos. So, I'm Phrase FX representing the Eminent Trading Academy. So, this is our second lesson of our program. Remember, last time we covered Forex. We knew everything about Forex. So today, I want to add on something very important. So by the end of this video, I want you to watch it to the end so that you gain from it. So foreign exchange market usually determines the relative value of different currencies. So the price of a currency is actually a reflection of what the market thinks about the current and the future conditions of a country's economy as compared to other economies. For example, when you buy the US dollar with the Great Britain pound, it usually means that you are buying shares in the US economy, expecting the US economy to outcompete the UK economy. Simply like that. For example, it's like here in Uganda. So when the news announces the US dollar prices going higher, this implies that the Ugandan shillings is weakening. And so which means that for someone who had bought some units of the US dollar would be making some good profit. So in short, the main task of the trader is to buy a currency pair when the exchange rate of that currency pair is expected to rise, and also sell the currency pair when the exchange rates are expected to rise. So these are some of the pairs. So we have the Euro USD. So Euro USD, simply this is a currency pair which is the most traded currency pair. Of course, it holds a lot of liquidity. It holds the most liquidity as compared to other currency pairs. So to give you a hint, this Euro USD contains 28% of the total liquidity in it. And when you bring it together with other major currency pairs, these major currency pairs, they contain 70% of the total liquidity. These other pairs contain 30% of the total liquidity. Remember, I told you that these financial markets, like the forex markets, they have an estimated liquidity of $6.6 trillion. I remember I talked about that in the previous video. So these currency pairs have three major types. So we have the majors, so we have the crosses and the exotics. The majors, the crosses, and the exotics. So the major currency pairs, these are currency pairs which represent the developed countries like the US, like the UK, the Germany, like the Canada, like Switzerland, those those developed countries. So these currency pairs are usually so liquid. So you know what liquid means. So they have a lot of money in their markets, and they usually have low spreads. So we shall cover spreads briefly in our next videos, but spreads usually refers to the difference in the sell quote and the buy quote. Also, these major currency pairs, another thing, they are so stable and they are predictable in relation to other asset classes like the small equity, cap equities and the stocks. So some of the major pairs, we have the USD JPY, you have the USD CAD, USD CHF. We have the GBP USD. I think when you look at these abbreviations, you can usually tell which currency pair is this. USD, US dollar, JP, Japanese yen. That is so simple. So we have the crosses. So these crosses usually do not contain the USD dollar in it, and they are ideal for diversification. For example, when an investor would like to invest in other countries' currencies, excluding the US dollar, so the US dollar may have some issues and complications, like the uncertainties. The US dollar may be having some uncertainties, like the geopolitical uncertainties, like the news events, etc. So some of the the major crosses, we have the GBP, JPY, the GBP, the Euro GBP, the odd card, like the Euro, AUD, NZD, JPY, card, JPY, etc. So these are the crosses. So for the exotics, since I told you that there are three types of pairs. So the exotics these are exotics. These usually represent countries that are developing, the developing countries. For example, the Hong Kong dollar, you get, like the Singapore dollar, like the Russian ruble, South African rands, those currencies from developing countries. So they are usually illiquid. They don't have enough money in it. If you investors invest in those currencies, you know that. And high spreads. I told you that we shall cover spreads briefly later on. Another hint is even the Scandinavian countries, like currencies from the Scandinavian countries, are also considered exotics, simply because even if they are from developed countries. So the Scandinavian countries refers to the countries like the Denmark, the Sweden, and the Norway. So thanks for watching. Let's follow me for the next video. Continue liking, support me. May God bless you. I sign out.